At 9:29 a.m., everything looks normal. Coffee is hot. Futures are steady. Analysts are calm. At 9:30, the opening bell rings, and within minutes, billions disappear. Not slowly, not one stock at a time, all at once. The strange thing about market crashes isn't that prices fall every day. The strange thing is synchronization. Perfect, terrifying synchronization. Different companies, different industries, different countries, all moving down together like someone flipped a switch. It feels chaotic, but it isn't. Markets don't crash because everyone suddenly discovers bad news. They crash because the system itself forces everyone to move in the same direction at the same time. And that system is built on three simple forces: leverage, liquidity, and psychology. Let's start with leverage. Leverage is just borrowed money. If you have $1,000 and borrow $9,000, you now control $10,000 worth of assets. If the asset rises 10%, you double your money. Amazing. If it falls 10%, you're wiped out. Leverage makes gains feel easy. It also makes small drops lethal. Now zoom out. It's not just individual traders using leverage. Hedge funds use it. Banks use it. Private equity uses it. Corporations use it to buy back their own shares. Even governments use it. The entire system runs on borrowed money, and borrowed money comes with conditions. If prices fall, lenders get nervous. They issue something called a margin call. It's polite language for "give me more cash, now." If you don't have cash, you sell assets. When many leveraged players face losses at the same time, they all need cash at the same time, so they all sell at the same time. That's the first domino. Now we add liquidity. Liquidity is the ability to sell something quickly without crashing the price. In calm markets, liquidity feels infinite. There's always a buyer. Spreads are tight. Charts look smooth. But liquidity is a fair weather friend. When volatility rises, buyers step back. Market makers widen spreads. Risk models flash red. Suddenly, selling pushes prices down much faster than expected. Here's the uncomfortable math. When prices fall, leveraged investors must sell. When they sell, prices fall further. When prices fall further, more investors hit their limits, so they sell too. It's a feedback loop. Not because everyone panicked at once, because the system mathematically forces them to. Now layer in psychology. Humans don't like uncertainty, and markets are machines that convert uncertainty into price. When investors see prices falling sharply, they don't wait for explanations. They assume someone else knows something they don't, so they sell preemptively. It's rational fear. Even institutions follow similar risk models. Many large funds use volatility-based rules. If volatility rises, they reduce exposure, not because they're emotional, because their models demand it. So, when volatility spikes, funds mechanically sell, which pushes volatility even higher, which triggers more selling. The irony is brutal. The very systems designed to manage risk end up synchronizing it. Think back to major crashes, 2008, 2020. Different triggers. One was housing and structured debt. The other was a global pandemic. But the pattern looked similar. Prices dropped fast. Liquidity vanished. Margin calls spread. Volatility exploded. Everything correlated to one. Airlines fell. Tech fell. Energy fell. Emerging markets fell. It didn't matter if the business was strong. In a liquidity event, quality doesn't save you. Cash does. That's the part most people miss. Crashes are rarely about one piece of bad news. They're about balance sheets. If too many players are stretched at the same time, the system becomes fragile.
A small shock hits. It exposes leverage. Leverage forces selling. Selling removes liquidity. Falling liquidity accelerates price declines. And suddenly, what started as a spark becomes a synchronized collapse. Now, here's where it gets more uncomfortable. Modern markets are more connected than ever. Banks lend to funds. Funds hold similar assets. Pension funds rely on derivatives. Corporations issue debt to fund buybacks. Governments depend on bond markets staying calm. Everything is intertwined. And many strategies are crowded. When one large player unwinds, others holding similar positions feel the pressure immediately. It's like a crowded theater with one narrow exit. No one plans to stampede, but when the alarm goes off, everyone heads for the same door, at the same time. Popular headlines blame fear, or greed, or one villain, but crashes are structural. They're the logical outcome of a system that rewards leverage during calm periods and punishes it violently during stress. The longer markets stay stable, the more risk quietly builds underneath, because stability encourages borrowing. Borrowing increases fragility. It's almost paradoxical. The safer things feel, the more dangerous they become. So, when markets crash all at once, it's not a mystery, it's not random, and it's rarely just emotion. It's synchronized math. Leverage compresses risk, liquidity evaporates, risk models align, humans follow price, and the system moves as one. The real question isn't whether markets will crash again. They will.